Hey everybody, this is Bob with Trade Genius. Got my good friend Phil with me today. Do you ever get mystified by the stock market, not knowing is it going to go up or go down? Well, fret no longer. We're going to show you an indicator that will put you on the right side of the trades all the time. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Hey Phil, could you demystify for us what this tool is that you've created to help people be on the right side of the trade? And before you get into how you can make money from it, maybe you can break down how it's built, how it's developed, why it works, and why it's going to continue to work into the foreseeable future. And then we can tell people how they can get it and use it for themselves. This thing is an awesome tool. It made me about $4,000 this week, and I think it's a tool everybody has to have in their toolkit.
Yeah, so why don't we just dive into the chart here and we'll start breaking it down. But primarily what this is doing, it's taking what is known as the Fed net liquidity. And if you're not familiar with what that is, and it's not something I came up with, it's just kind of a known thing in the financial world where you take the Fed's balance sheet and you subtract the sum of what's going on with the Treasury account or the Treasury general account, which is basically the checking account for the Treasury. So Yellen's piggy bank, basically. And you take that plus the overnight repo balances. This is where the big banks park their money at the Fed for basically free money, right? So you take the sum of those two items, the Treasury's general account and the overnight repo, and you subtract that from what's going on with the Fed balance sheet. And the net of that gives us what we call the net liquidity, or the Fed net liquidity. And what that is basically the fuel for the market. So if the Fed is rolling down its balance sheet, it's taking liquidity away from the market. If Yellen is decreasing her balance, that's adding liquidity, or if she's increasing her balance, that's taking liquidity away. If the reverse repo market is going higher, like they're parking more money at the reverse repo window, that's taking money away from the market. If they're parking less money at the reverse repo window, then that's more liquidity for the market. So rather than you trying to track all of that stuff, this is going to do it for you. And that's what that blue shaded area is. So the next thing is, okay, and you can see like the market more or less follows the blue area, right? That's the Fed net liquidity. And what's difficult about following that is it's somewhat jagged in how it prints every day and every week. So what we did is we added some smoothing measurements to it so that we could kind of basically take the jaggedness out of it and give us consistent signals as far as when the net liquidity is turning up, meaning that would be a buy signal or a risk on signal, or when it's starting to roll over and they're taking liquidity away from the market, and then that would be a sell signal or a risk off signal. And so that's what we've done. We've basically added that measurement, and then we also did something else. We gave you the blue area, which is the net liquidity. We give you the risk on, risk off signals. Okay, that's those diamonds. The other thing we did was we also added this fair value. So what it's doing is it's looking at basically what is fair value relative to the net liquidity. Okay, so once we establish that, we can then mark when the market is overbought relative to the available net liquidity, or when the market's oversold relative to the available net liquidity. And that's what these circles represent. These aren't part of the indicator. I just manually put these circles in here just to show you that if you just use the fair value part of this system, you would see where it's capturing all of these swing highs and swing lows. You see that? I mean, this is a very powerful tool in and of itself. So when you get these extremes, and we're just coming off these extremes, and this is why we said be careful up here, because we're getting into this overbought. There's two levels. There's a short signal line, and there's also euphoric when this market has really gotten way overbought. And usually once you hit euphoric, you can just go short, give yourself a couple, 3 weeks if you're in options, and you're going to get paid time and time again. Same for on the bottom. If you're going to get down into the buy signal zone or the capitulation zone, which would be even better, you're going to get really nice bounces. And the buy side usually pays you a lot quicker than the sell side. Sell side sometimes takes a few days longer to manifest. That's just the nature of the markets. Whereas the buy signals we like better because they tend to be sharp reversals. Sometimes you just get that clean V reversal off of it and you get a really big move. So when people are trying to figure out, what moves the market, or why does the market top out where it does, or why does it bottom where it does, quite often it's because of what's going on with the net liquidity. So for me, and I believe for Bob too, having this tool is invaluable because it's basically your map as to what the market's doing, where it's likely to turn. And really at the end of the day, until things change, all that's really driving this market is this net liquidity. You can talk about fundamentals, you can talk about a myriad of other things, but at the end of the day, whether this is going up or this is going down is driving the market. And it's also a measure of where the market is in terms of being really overbought against it or really oversold against it. Knowing those data points is going to really help you in terms of trying to swing trade this market. We just closed the swing trade this morning because we got short up here. Now we know the debt ceiling is going on, but even then, with the headline risks that are out there, you know that this was a safe spot because of these readings up here. So we got short up here in futures. Some took options out, but in any event, that rollover finally happened. Now, because it's the debt ceiling debate, there's obviously going to be a spike when they come to some sort of resolution. So we're looking for that again. If we get another reading up here where it tells us to go short again, or maybe it's a euphoric level on the spike from the debt ceiling resolution, probably another easy short trade to take. So without knowing this information, without knowing that the market's overbought or oversold relative to the net liquidity, it can be a little bit of a guessing game. You do have your indicators and they can give you the short-term signals, but if you want like the longer-term, bigger swing trade signals, you definitely need this tool.
Yeah, and what Phil means longer term, I went ahead and I put shorts on the close on Monday, and I just closed my short position on Wednesday, which is today actually, and it was $4,000 between SPY puts and Q puts and going long SARK just to take advantage of that. And what triggered me is if you look at those two red circles on the bottom, where Phil put on the top, is that we went into euphoria and then we went into short hedge. And even though the system was flashing a risk on, is that when you get risk on and then you get basically an overbought, you get these sharp corrections, but you don't stick around with it. So it's really cool, this tool. So you're either really strong long when you get a oversold reading and you get a risk on, just push the chips in hard. And then if you get overbought and your risk on, you can sell credit spreads against it. And vice versa, when you get a risk off signal, but you're oversold, you can sell put spreads underneath it. So there's a lot of options. Phil likes to do futures. I like to trade the option market. They both work great. And then we both sold just because you never know when these clowns are going to make an announcement. So you take your money and you run in this market. But the really cool thing about this is that if you're starting to get sell signals, you can layer in. And the other thing too, like the service that we have, I've been telling people for a week now that we're pushing up here against this risk on but overbought. It makes no sense to take too many long bets because you're going to get a pullback. Wait for the pullback, then buy. And so that's what we're doing. And this is going to become even more important because we've been having an environment where the Fed and the Treasury have been at odds with each other, and the banks have kind of been playing it in the middle. We're going to get in a situation here over the next 3 to 4 months where the banks, the Treasury, and the Fed are all going to be in sync. And it's going to be really, really, really important to know when to take on these short trades because they're harder to take than long trades, and when to pull off the chips and when to reload again, because it's going to be very violent but extremely profitable if you're just following this tool. And just real quick, Phil, I'm just going to let people know you can go to tradelikeagenius.com, hit chat, call us, and we're selling this for the retail price is $179 per year use, which is cheap, and what you're going to get out of it. But you could use promo code Memorial and you can get 45% off on it. And you can take advantage of that by Saturday. And I encourage you to do that. And so check it out. I think you'll really, really like it. And Phil also has a newsletter where he uses this tool, and he also gives levels and a little bit more macro and micro looks for anybody that wants to day trade. So with that, Phil, our commercial is over. I think you guys would appreciate it and take advantage of this tool because, like I said, this thing will pay for itself in the first couple trades you make. And with that, Phil, turning it back to you.
I think that pretty well sums it up. The only thing I'll leave you guys with is you'll notice on fair value, we go from red to green. Red meaning get out of town. Green means load up the boat. Well, we've gone up to red. Now you guys can probably figure out where we're headed. So we'll probably get another rotation down to green. And that's what really we've been warning about. And I think can be a substantial drop from here. This could even be the start of a move that takes out last year's low. It could be that big. So again, this tool is going to let you know when it's safe to get back in the water and when it's time to get out because the sharks are on the prowl. So encourage you guys to check this out over at our website, as Bob said. Other than that, guys, thanks for watching. Please hit like and subscribe. We'll see you on tomorrow's video. We'll see what today happens with the FOMC minutes and the debt ceiling, see if there's any resolution on that, and we'll go over that stuff tomorrow with you guys. Thanks, Bob.
Thanks, Phil.
Trade Genius.